Let's talk about what today's agenda is. And one of the things I want to go over with you guys is there's going to be 4 pieces to this, and we're going to move pretty quickly. We are going to talk about the Domestic Partner Tax Equity Act. We're going to talk about what I call Domestic Partner Tax Inequity 101, the Business Coalition for Tax Equity, which is going to be the call to action for you guys. So as you leave today, we will be setting the foundation of how can you get your companies involved in this. As of 2005, 45% of Fortune 500 companies had domestic partner benefits. That's a 10-fold increase from 10 years prior. In Minnesota, we have 169 companies with domestic partner benefits. And our hope is every single one of those 169 companies are on the Business Coalition within the next 6 months to a year. And what I think this also underscores is how companies are leading the charge. Companies are ahead of the state and federal laws that we currently have. Domestic partners are taxed differently than married couples in terms of the health care benefits. Another piece I think is really important for us to be clear on. Domestic partner does not mean same sex. Domestic partner can mean heterosexual couple as well. Another fact is that employers offer domestic partner health care benefits, and employees who receive them are taxed inequitably. So it's not just the employee, but it's also the company. And this domestic partner tax equity bill would eliminate the taxation that for the individual as well as for the company. I think that there are many times smaller nonprofits and even smaller companies have not offered domestic partner benefits because of the systems issues of being able to try to track the imputed income. So if these laws change, it's not so much even how many more benefits can we offer, it's just how much easier and how many fewer systems it's going to take in order to be able to give these benefits. So I would encourage companies, even if right now they don't have the resources to offer domestic partner benefits, that they actually try to get their companies or nonprofits to sign up for this. When you pay your premiums every month, right? Your premiums for your health care come out of your pay pre-tax dollars, okay? You guys know that, comes out of your pay pre-tax dollars. If you're married, your spouse's premiums come out of your pay pre-tax dollars as well. If you have a domestic partner on your insurance, your premiums come out pre-tax dollars, but your partner's premiums come out of your paycheck post-tax dollars. So we're looking at people who both have a salary of 40 grand a year. And the imputed tax is actually the dollars that a company puts into and contributes to the health care of the individual. Okay, does that make sense? A company puts in a certain number of dollars, and that's going to fluctuate from company to company based on different healthcare plans and such. But we pay a premium, but behind the scenes, the company's putting a lot of other money into for us to have health care. Same as when we get health care benefits for spouses or domestic partners. However, the number of dollars that the company contributes to the partner's benefits is then seen as income to the employee. So if the company puts in $200 a month towards a domestic partner's health care, at the end of the year, the employee is going to appear to have made an extra $2,400 because of those contribution dollars. Okay? So in doing the math, pre-tax dollars, the $1,200 came out of the employee's salary. So it really appears for taxable dollar reasons that the employee with the spouse makes $38,800, which is good when it comes to paying taxes. So 50%, and that's going to change, to whether it's 50% in terms of the premium dollars, but I tried to keep it simple for these purposes. But 50%, again, will be pre-tax dollars for the employee. So $600 will come off the $40,000. But then you add on the $2,400, and it now appears as if the employee with the domestic partner makes $41,800. That equals out to be $3,000 extra in taxable income. So this is what we're trying to change. This is what we're trying to get rid of, is the taxation not only to the employee, but the way it works for the company is that when it appears like the person with the domestic partner health care benefits, when it appears that they have a higher salary, the company has to pay taxes to the government on that. So it's kind of this ghost money, right? But lots of taxes are being paid on it. So that's the benefit to the company as well. Not only just to have equal treatment and have engaged employees, but also it benefits the company.